CRR, SLR, Repo Rate, and Reverse Repo Rate. These four terms confuse many students. But once you understand the simple logic behind them, they become easier. These are some of the most important monetary policy tools used by the central bank. Let's break them down step by step. But before we start, we need to understand one simple flow. The central bank does not directly control prices in the market. Instead, it controls commercial banks. When the RBI in India changes its policies, commercial banks adjust how much they lend and at what interest rate. Banks give loans to businesses and consumers. Loans influence spending and investment in the economy. This spending affects total demand in the economy. And demand ultimately determines inflation and economic growth. So remember this simple flow. RBI to banks, banks to loans, loans to demand, and demand to inflation and growth. This is the core mechanism behind monetary policy. Now the question is, why does the RBI or any central bank need these tools? Inflation happens when excess money in the economy increases demand and pushes prices up. On the other hand, growth slows when borrowing becomes expensive and investment falls. So the central bank faces a dual challenge, controlling inflation while also supporting economic growth. To manage this balance, the RBI uses two types of tools. First, it controls the quantity of money banks can lend through CRR and SLR. Second, it controls the cost of borrowing through repo and reverse repo rates. Let's begin with CRR, the cash reserve ratio. CRR is the minimum percentage of deposits that commercial banks must keep as cash with the RBI. This money cannot be lent and earns no interest. So when the RBI increases CRR, banks immediately have less money available to lend, and that directly reduces credit in the economy. Now let's look at the second quantity control tool, the statutory liquidity ratio or SLR. SLR is the minimum percentage of deposits that banks must invest in liquid assets such as government securities or gold. Unlike CRR, banks earn interest on these investments. However, these funds still cannot be used for lending to the public. So when SLR increases, banks still have less money available for loans and lending in the economy declines. Now let's see the full impact. When CRR or SLR increases, banks must keep more reserves and have less money available for lending. As a result, bank liquidity falls. With lower liquidity, banks reduce lending. Lower lending means the money supply in the economy contracts. And when money supply falls, demand pressure reduces, helping to control inflation. This is why CRR and SLR are considered RBI's strongest liquidity control tools. Let's quickly compare CRR and SLR side by side because students often mix up these two reserve requirements. In the case of CRR, banks must keep a portion of their deposits as cash with the RBI, whereas under SLR, they keep a portion of their deposits in liquid assets like government securities or gold. Since CRR is kept as cash with the RBI, banks do not earn any interest on this amount. But under SLR, banks invest in government securities, so they do earn interest on these investments. Because CRR funds are completely locked with the RBI, it has a strong and direct impact on banks' liquidity. SLR restricts lending, but since the funds are invested in assets, the impact on liquidity is relatively moderate. So in simple terms, CRR funds are fully unavailable for lending, while SLR funds are invested in assets that still generate income for banks. Now that we understand how the RBI controls the quantity of money banks can lend, let's move to another set of tools that control the cost of borrowing, the repo rate and reverse repo rate. Repo rate is the rate at which the RBI lends short-term funds to commercial banks, usually against government securities. When this rate changes, banks adjust their own lending interest rates. So repo rate directly influences how expensive borrowing becomes in the economy. In simple terms, repo rate represents the cost of borrowing. Now let's understand how the repo rate actually affects the economy, because this is one of the most important monetary policy tools used by the central bank. First, consider what happens when the repo rate increases. When the repo rate rises, borrowing from the central bank becomes more expensive for commercial banks. As a result, banks increase their lending rates. So, loans for businesses and consumers become more costly. When borrowing becomes expensive, investment and consumption start to fall. With lower spending in the economy, overall demand decreases, and this eventually helps reduce inflation. Now let's see the opposite situation when the repo rate decreases. When the repo rate falls, banks can borrow money from the central bank at a lower cost. This allows banks to offer cheaper loans to businesses and consumers. Lower borrowing costs encourage more investment and more consumption. As spending increases, demand in the economy rises, which can lead to higher economic growth. So, in simple terms, an increase in the repo rate helps control inflation, while a decrease in the repo rate encourages economic growth. So far, we have seen how the repo rate affects borrowing costs and economic activity. But the central bank has another tool that works in the opposite direction, the reverse repo rate. The reverse repo rate is the rate at which the RBI borrows money from commercial banks. When banks have surplus funds, they can park that money with the RBI and earn interest. This tool helps the central bank absorb excess liquidity from the banking system. So, reverse repo becomes a tool the RBI uses to absorb excess liquidity from the system. Now, let's look at how the reverse repo rate affects the economy. When the reverse repo rate increases, banks prefer to deposit more money with the RBI because they earn a higher return. As a result, bank liquidity falls, bank lends less, the money supply in the economy decreases, and this helps control inflation. On the other hand, when the reverse repo rate decreases, banks deposit less money with the RBI. This increases bank liquidity, lending rises, the money supply expands, and economic activity increases. So while the repo rate influences borrowing, the reverse repo rate helps absorb excess money from the system. Let's quickly compare them side by side so the difference becomes very clear. In the repo rate, the RBI lends money to commercial banks, whereas in the reverse repo rate, the RBI borrows money from commercial banks. In the repo rate, banks borrow funds from the RBI against government securities, while in the reverse repo rate, banks deposit their surplus funds with the RBI. As a result, the repo rate injects liquidity into the banking system, increasing the funds available for lending. In contrast, the reverse repo rate absorbs liquidity from the banking system, reducing the money available for lending. So, in simple terms, the repo rate is used to influence the cost of borrowing, while the reverse repo rate helps the central bank manage excess liquidity in the economy. You can remember it like this: repo, RBI lends, money enters the banking system. Reverse repo, RBI borrows, money returns to the central bank. And before we wrap up, there is one more concept that students often confuse with repo and reverse repo, the bank rate. So in the next bonus slide, let's quickly see how bank rate compares with repo rate and reverse repo rate. Repo rate is when the RBI lends money to banks against government securities. Reverse repo rate is when the RBI borrows money from banks. And bank rate is when the RBI lends to banks without any collateral. Finally, let's summarize the monetary policy direction. When inflation is rising, the central bank follows a tight monetary policy. In this case, tools like CRR, SLR, repo rate, and reverse repo rate are increased to reduce money supply in the economy. On the other hand, when economic growth is slow, the central bank adopts an expansionary monetary policy. In this case, these policy rates are reduced to encourage lending, spending, and investment. Save this video for revision. If you want to revise more board exam concepts, I have also made videos explaining what is inflation, difference between fiscal policy and monetary policy, and common mistakes students make in economics exams. You can check them on my channel. I'll see you soon.